Good evening, and welcome back to another video of Grey Man's Profits for intermediates. Well, today I've got a zinger for you guys. We are looking into the value area rule, which you might have not heard of, but it's an old school technique that's been around since the 80s and is one of the original strategies for planning out passive trading. And it's a long trade, so this is something that I'm not normally familiar as a swing trader myself, but it seems like it's got a very reliable tactic, saying that the tactic normally plays out about 80% of trades. So, let's get into it. First of all, what is VA, or the value area? Well, I didn't know this until a few days ago, so I would not be worried if you don't know as well. All it is 70% of the trades taken on the previous day. So what you do is you look at the volume of trades, and you go, okay, where was the largest volume? And then you mark it out, going, okay, out of 100% of all the trades, where is the margin of the 70%? And what you do is you mark out the top, and you mark out the bottom, and you direct it over to your new day. But how do we utilize this? Let's get into it. So, just remember, this strategy only works if price starts outside of the VA zone. Okay. If price opens outside of the VA zone, wait for price to move back into this new demand zone, which of course is where the volume wanted to go from yesterday. So then what the strategy is you place a long trade from the entry to the opposite side of the VA. And then you let it play out. And this trade, while I say it might be a little bit risky, is it's most likely going to take all day to either hit TP or steadily grow. But I have a feeling that you'll see quite a lot of profit, and of course, if the market moves, you can always exit. And I would recommend that you move your stop loss to meet up with this trade, so you follow it slowly over the duration. But let's look at a mock draft of this would be a mock graph of how this would play out. So, let's say yesterday, price started off pretty low, and Asia and London both went for a consistent move. So Asia has come up to a peak, and London has manipulated downwards and come back up. And then a New York PM session has distributed down, saying that it has exited the volume and price VA mark, where the most volume of the trades was taken, of course, at the peaks and during the manipulation and distribution. So, what do we look at here? So we realize that price has dropped outside of this demand zone. So, we place a long, let's say that we put our stop loss at the lowest low of yesterday. And you wait for price to reiterate into this demand zone, and you put a TP, let's say at the highest movement of yesterday. If you wanted to play it more safe, then you would go with, okay, maybe the session high that manipulated first. So you would go, okay, either set it at the high of late London, just before the distribution, or before the movement in Asia, in this scenario. And then what you do is you watch it grow. The funny thing about this technique is when it's reliably put into a graph, it has an 80% chance of covering this foundation. It has an 80% chance. I'm not kidding you. 80% chance of going from one side of the VA to the other from a day-by-day standpoint. That's unheard of. Anyway, so let's continue through. The one negative side of this is volatility. So the volatility of a market can depict how probable this is going to be. So of course, if you're trading an index fund, and let's say NASDAQ or something else, or even let's say gold. Gold is highly sensitive, and so are quite a few other ones connected to the US dollar. So if you're trading something that is connected to the US dollar, or an index fund that has outside influences, I would not recommend using this strategy. But let's say that you're trading a pair that is more stable. You go EU to maybe GDP, or EU to the yen, or something like that, where it's more consistent, more relaxing, more predictable structures, and less volatile, this strategy might work for you. And one of the things that's beneficial about this is just what I said before, that one, you can set it up so that you go, okay, I'm going to go for a long and it's more predictable. But more importantly, if the market does change in any way, you have risk management. You can always, as soon as it goes up, adjust and follow it. And the best part about this is it's hours and hours long that you might have to wait for. So it's not going to be a quick success, but at the same time, the change in the market is not going to be as drastic as well. Well, I hope you've learned something, and if you want to utilize this technique, give it a go. Well, I hope you have a lovely evening, and once again, be the grey man.